I hope everyone is doing well and having a great semester. I want to welcome you to this week's video talking about Chapter 10's long-term liabilities. Okay. Let's start the first one. It says Mira Corporation issued 4,000 8% 5-year $1,000 bonds dated January 1st, 2014 at 100. Okay, so to record this, start by putting the date down. January 1st, 2014. And you issued them, so you want to debit cash. Now, let's see for how much you're going to do it for. Now remember, there was 4,000 of these bonds. Okay, so take 4,000 and multiply how much they're each worth. They're each worth $1,000. Take 4,000 times 1,000. So that'll equal $4 million. So we'll start by debiting cash. $4 million. Now you issue these bonds, except now you have a legal liability to these bond holders. So you want to credit bonds payable for $4 million. Okay. That's the next one now. Next one here says prepare the journal entry to record the first interest payment on July 1st, 2014, assuming no previous accrual of interest. Interest payable semi-annual. Now, semi-annual means interest will be paid out twice a year. Okay. So let's start with the first part. Put July 1st, 2014. Okay. And now, to record interest payment, you always debit interest expense. Okay. Now let's see how much it's going to be for. Well, we know the bonds total is worth $4 million. Okay, so take the $4 million and multiply by the interest, which is 8%. Now, because semi-annually, it's going to be paid out twice a year. Now, this 8% is for the entire year. So we got to multiply it by half of that. So 4 million times 8% times 1 divided by 2. So total interest that will be paid out here will be $160,000. So debit interest expense for $160,000. Now it says here it was interest payment. So you used cash to pay this. So you want to credit cash to decrease cash. So credit cash for $160,000. Okay, so now it says here prepare the adjusting journal entry on December 31st, 2014 to record interest expense. So here, December 31st, 2014. Again, we're going to debit interest expense. Now, the amount of interest expense will be the same exact amount as we put in Part B. It's the same calculation. Okay, so put $160,000. Now, we're not going to credit cash because this one just says adjusting entry. That means the interest has been accrued but not yet paid. Okay. So you want to put this account to interest payable, which is a liability. And we're increasing that. So we credit it for the same amount, $160,000. Now Part D says put journal entry to record the redemption of bonds at maturity. Now remember, it was January 1st, 2014, 5 years. So maturity will be at January 1st again at 2019. Now to record them at maturity, start off by debiting the liability, which is bonds payable. Okay. For the full amount, we put in the original 1A for the $4 million. Now, when it matured, you had to pay all your shareholders. And what you used to pay for that, you used cash. So you want to credit cash for $4 million. Okay. Now we go on to the next one here. So the company issued 10% 10-year bonds with a par value of $1 million on January 1st, 2013. They were sold at $885,295. The buyers are given a 12% return. Company used effective interest amortization method. Interest paid semi-annually. Okay. So we got to make a chart here. Okay, so we start the first part. The first part is how much is our cash payment going to be, which will be our interest. So we start the first part here. So we know the bond is worth $1 million. So take the $1 million. And you multiply it by the 10%. And again here, as we did in the previous one, it's semi-annually, so you got to multiply again by 1 divided by 2. So the interest here will be $50,000. Okay, so to fill this little chart, put here $50,000. Okay, now, how much is the bond interest expense going to be? Well, We're not going to use $1 million. Like it says here, it was sold at $885,295 and multiply it by, you give the buyer's 12% return, multiply by the 12%. Okay. And we still multiply by half a year because it's still being completed semi-annually. Okay. So this now will equal $53,117.70. Okay, the bonus expense here will be $53,117.70. Now, the next part we're going to calculate is the amortization, discount amortization. That would be the difference between the bond interest expense and the cash interest paid. So we take the $53,117.70 and subtract the $50,000. Okay, so this will give us $3,170.70. That's how much we amortize per period. It will be $3,117.70. Okay. Now the next portion is how much is the unamortized discount portion. Okay, so we start off with the $1 million. Okay, subtract how much you sold it for, which is $885,295. Except you also want to subtract out how much you amortize, which is the $3,117.70. Okay. So altogether, this will equal $111,587.30. Back up here, so this will be $111,587.30. The last part is, what is the carrying value? Again, start off with the $1 million. And then you subtract out the unamortized discount portion, which is calculated at $111,587.30. So this will equal $888,412.70. Go back up here, our carrying value is $888,412.70. Okay, that was for June 30th, 2013. Okay, now move on to December 31st, 2013. Now, to get the cash payment, it's going to be the exact same as we just calculated, 100% the same. Okay, still just take the 1 million times 10% times 1/2. That will be $50,000. This is $50,000. Okay. Now, the interest expense will be a little bit different. Interest expense will be start with the carrying value. Okay. Carrying value is $888,412.70, and multiply by 12%. And we have semi-annually, half a year. Don't forget multiply by 1 divided by 2. Okay. This will be $53,304.76. Here, put $53,304.76. And then discount amortized. Did earlier. Start off with the $53,304.76 and subtract the cash payment, which was $50,000. This will equal $3,304.76. Discount amortized portion is $3,304.76. The last part, the unamortized discount portion. So we start off with the $111,587.30 and take out the discount amortized portion, which we just calculated at $3,304.76. So that'll equal $108,282.54. Okay, so we go over here, put $108,282.54. The last part, to get the carrying value. Again, start off with the $1 million. And subtract out the unamortized discount portion we've just calculated at $108,282.54. Okay. That'll equal $891,717.46. Okay, so value, put it here. That'll be $891,717.46. Now, 2 said, prepare the journal entry to record the first semi-annual interest payment. So that'll be the one at June 30th, 2013. So we're going to start off by putting to bond interest expense the full amount for the $53,117.70. And then you want to credit cash for the $50,000. The last part, you want to put here discount on bonds payable for the remaining portion of the discount amortization, which is $3,117.70. Okay. Let's go to the last one now here. It says for Journey & Company receives $300,000 when it issues a $300,000 10% mortgage payable to finance the construction of a building at December 31st, 2014. The terms provide for semi-annual interest payments of $25,000 on June 3rd and December 31st. Budget enters to record the mortgage loan and the first 2 installment payments. Okay. So the first one would be for when you receive the loan. So put here that happened on December 31st, 2014. Start by debiting cash for the amount you received. You received $300,000. Take $300,000. And then you want to credit what you got here, which was a mortgage payable for $300,000. Now the next 2 will be for the payments. So the first, because of semi-annual payments, the first payment will be at June 30th, 2015. Okay, now remember, this payment, you're going to have interest and principal in it. Okay, so start up by debiting interest expense. Now, let's see how much interest expense is going to be in there. Okay, well, we know the loan is for $300,000. $300,000. Then multiply that by the interest rate, which is 10%. Okay, the last part, because it says semi-annually, multiply it by 1 divided by 2. Okay, so that'll be $15,000. Okay, so I'm going to debit interest expense for $15,000. Now remember, it said the payments will be for $25,000. So $15,000 has to go to interest, so the remainder, you're going to debit mortgage payable to decrease that by the remaining $10,000. And because, like I said, the payment was for $25,000, you want to credit cash for the full amount, $25,000 to decrease cash. Okay. Let's go to the last one. The last one says here it now be at December 31st, 2015. All right. Now, the accounts are all the same. Still going to debit interest expense, debit mortgage payable, and credit cash. Except the amounts vary because now you paid more principal. So now let's take a look at the interest expense. Well, the loan amount was original for $300,000. Take $300,000. Except after you made that first payment, remember, it went down $10,000, so subtract $10,000 from it. Interest rate will still be 10%. It's multiplied by 10%. And because it's, again, semi-annually, multiply by 1 divided by 2. So now this will equal $14,500. As you make more payments, remember, your interest expense should be going down. Debit interest expense, $14,500. Now remember, the amount will still be $25,000 you're paying. So take $25,000 minus $14,500. So mortgage payable now will go down to $10,500. And then we still credit cash for the full amount you pay, which is $25,000. Okay. All right, class. If you have any questions, comments, concerns, please feel free to contact me. If not, have a great week, and I hope to hear from you soon. All right, thank you.